Welcome back. If you recall last week, we spoke about the VIX and that big spike up. I think it was on the Thursday the 6th. We see here the days range for the VIX at the time was 1479 up to 1708. Now it closed for the day in the 15s. But what was significant was we had a I think almost 3 point spike to the upside. And we discussed what could be a low volatility trading strategy to apply under these circumstances. So I wanted to revisit exactly what happened and what happened since then. This is the S&P 500 in red, and focus in on the 6, which is this big line down. When this occurred, we can see this white histogram bar, which measures the point change of the VIX. Now, this measures closing prices. Again, the VIX closed only 1 point up for the day at 15 and change, but intraday it was as high as 17. And that would represent, if it did close at 17, it would represent a 3 point move from 14 to 17. And that is pretty significant because big point moves up 3, 4, 5 points to the upside in the VIX. The VIX goes up when the stock market goes down. You see, the VIX is also known as the fear index. It measures a premium on the front month options on the S&P 500. When stocks go down, the premiums on the options to protect stock positions rise. So a big spike in the VIX, which is what we saw last Thursday, even if it was intraday, does tell us that the market, at least on a short-term basis, has sold off quite a bit. Now, the stipulation is, does the VIX stay below the 20 level? If it stays below 20, it's considered still to be a strong market. This is the S&P 500 in red, and again, 7-6, July the 6th, which is this move down over here, that's when the S&P 500 hit a low of 43.99. Again, the VIX only closed at 1 point for the day, but watching the market intraday, it was actually up as much as 3 points. Now, the strategy is exactly this. The white line here is the S&P 500. The red line is a 20 simple moving average. Now, there's nothing special about the 20 simple moving average or the 25. It's just a very commonly used moving average. A lot of traders choose to buy when the market comes back down and tests and does not break below the 20 simple moving average. Now, notice the position of the VIX. The VIX is 15 when the market came down. Now, if the VIX was above 20 when the market was coming down, it would not be a buy signal, because when the VIX is above 20, it means that the market's going down a lot, and maybe it's going to go down a lot further. You see, the area between 15 and 20 is a normal area of fluctuation in a strong uptrending condition in the stock market. But when this uptrend turns into a downtrend, that's when the VIX breaks above 20. Or at least there's not a confirmed uptrend like we saw in the past. Now, this week, again, this is what the VIX looks like. The trade signal occurred, and we're not, issuing official trade signals here. Not at all. We don't know risk tolerances and that sort of thing. But if we're looking for a low volatility buy on the dip in a strong uptrending market, this is one scenario where the red line, the S&P 500, comes down. It touches, but does not break below a moving average, like in this case, a 20 simple moving average, while the VIX remains below 20. Between 10 and 15 is especially very encouraging. If the VIX had closed at 17, I don't know, that would be a little bit of cause for concern. But because the market bounced at the 20 simple moving average and the VIX bounced at 17, it came back down, it showed us that this was most likely a level of support for the markets, for the stock market, the S&P 500, and most likely a level of resistance for the VIX. Since then, the S&P 500, after hitting a low around 4,400, 43.99, I think, has since then rallied up to 44.39, about 40 points. Not a huge rally to be certain, but definitely a nice bounce for a day trade, or rather a swing trade. Now, speaking of stock market indices, I want to also revisit an analysis that we do by looking at the different major stock market indices. The Dow Jones Industrial Average is the 30 largest stocks. Coca-Cola, Home Depot, Boeing. S&P 500 are 500 of the largest listed stocks. That's more of a representative look at the market. The NASDAQ, which is very strong this year, is heavily weighted by technology. And the Russell 2000 is a small cap index and measures those small stocks. Comparing one index to the other can give us a tremendous amount of insight. But in this case, we're looking for something called convergence divergence. We're looking for massive agreement, maybe too much agreement in the market. Now, the way we do so is we look for the ranking. We take a look at the rank of each index over the past year, 365 days, calendar days. And we say, is today the number one day for the Dow? Is it the Dow the highest that it's been in the past year? If it was, it would have a ranking of number one. If it's the second highest day, number two. Well, we rank all four different stock market indices, the Dow, S&P 500, NASDAQ, and Russell 2000, and we compare the spread, the difference in the rankings between all those different indices. And what we're going to notice is when there's a massive agreement, when all of these indices are trading very close to the high or to the low, and the spread is very low, the difference is very low, they're all trading together, usually that's a sign that maybe the stock market's going to turn. Well, in this case, we see here the purple line, that's the S&P 500. That currently has a ranking of very close. I see the NASDAQ is at 8. The S&P 500 probably also right around 8. The red line is the Dow Jones Industrial Average, that's at 20. The yellow line is a Russell, that's around 30. So the Russell's in the 30th best position that it's been all year for the past year. The S&P 500, the Dow, very much closer to the high. The black area chart at the bottom shows us the spread, the difference between the strongest and the weakest. So the strongest arguably is the S&P 500. That's at 8. The weakest is the Russell. That's at 30. Well, the difference between the strongest and the weakest is the spread. That's around 22. That's where we are now, all the way down here. We only have a 22-point spread in terms of the rankings between the strongest and the weakest. Now let's take a look back in terms of historically what this means. This is the year 2000. Blue line's the Dow Jones Industrial Average. We hit that really big high May of 01, 11,338. Everything looked great. Well, as the Dow was trading near its highs, all of a sudden, well, just before that actually, we saw a sell-off on March of 2001, and then the market rallied again. Now notice, as the market was really kind of trending, all of a sudden the spread collapsed. This is the point of real concern, when the spread's very, very low. When the market's in a trading range and all of a sudden all the indices agree, then the market collapsed. The Dow Jones comes down to level of 8236. Of course, these were very unusual circumstances. It's no surprise that all the markets collapsed together, but the spread was literally zero. Every single market was trading at the low of the year. Well, then the Dow rallied back up, and we see different indices move up higher than others, which is natural. And then the market started to move down. Now, when the spread drops down to near zero, it shows us momentum. It shows us that all the markets are going together. It's not necessarily a signal that the market's going to all of a sudden turn in reverse. But usually when there's a massive consensus, it means two things. We're all going to go in the same direction, but when we are all going in the same direction, we could soon turn directions. And notice we hit that very big low July 23rd, 02, and then a very big low October 9th, 02. Dow at 72.86, believe it or not, and the spread was zero. All the markets were near zero, with the spread, I should say, was near zero. This is 2008. This is probably a better example of what we're talking about here. Notice Dow Jones Industrial Average in 07 comes up to very significant highs. 13,500 and change, that's July. Notice the spread. That means, although we only see the Dow here, all the indices were nearly at the high or at the high of the day. Well, the market starts to crack and then rallies back up, and we see a trading range here, and the spread shows us with a massive amount of consensus. Now, notice then when the market cracks, the spread increases. What does that mean? When the spread increases, it means that some indices are moving ahead of others, and that's natural. All markets should not trade together. After all markets move for different reasons. The Dow moves based on the movement of Boeing and Disney and McDonald's and Coca-Cola. The Russell moves based on those little stocks. So earlier this year when we had the small cap banking crisis, and Russell 2000 really got hurt. It didn't really hurt the Dow as much though. So there are, differences between these different indices. The Nasdaq is heavily weighted towards technology. When we have a technology crash, that's not going to hurt, it'll hurt the S&P 500, not necessarily the Dow as much though. Notice when the market all of a sudden developed a tremendous amount of momentum, and then we hit those very big lows and eventually hit lows March of 09, 65.47. All the markets agreed, yeah, it's really bad, we're going down. Well, just at the point that all the markets agree, that's usually or oftentimes the case of a reversal. Same situation, 2019, Dow is at this is at 2600 on the Dow, September 18. Things looked really, really good at this point. The spread's very low. Lots of agreement, almost too much agreement. Then the market cracks. And eventually we hit these lows, December 25th, 18. Then the market returns. So fast forward to present day. This shows us the red is a Dow, the yellow is a Russell, just to show you, two markets. That's not as important. What's important is the current spread. The current spread today is 23. We said 22. It's actually 23. It's very, very low. It tells us two things. All markets are moving in the same direction. It does not mean they're going to turn tomorrow, but just be aware. Historically speaking, the data does suggest when markets all begin to agree, well, they're going to continue to go in that same direction. The trend is your friend, to be sure. But eventually, all markets agree, and that usually is followed by a massive disagreement when one market cracks in the other direction. So we have a very low VIX, which indicates a strong uptrend, which is confirmed by a very low spread. So this is not at all a sign that things are going to change tomorrow or the next day. But just be on the lookout for signs of, something else to come. Maybe for the spread to increase, and definitely for the VIX to increase. We're going to watch both these indicators very closely in the days and weeks to come. We hope this has been helpful. We look forward to seeing you back soon.